In this example, we'll use the perpetual inventory method and weighted average to determine the ending inventory and cost of goods sold. Remember that our units are the same for all three methods. We started with 60 units in beginning inventory, purchased 170. That gave the company 230 units available for sale. At the end of the month, there were 60 on hand, meaning that 170 were sold. This information will remain the same, but the ending inventory and the cost of goods sold vary depending on the costing method being used. At this time, we'll use the weighted average method. In this method, the weighted average cost is recalculated every time there is a purchase or a sale. Weighted average is used often when we have units that are relatively similar or totally similar. For example, screws. You don't really want to keep track of individual or even groups of screws for costing, and they're all the same. So it doesn't really matter if you grab the newest or the latest, and weighted average can be used just to simplify things. Okay, remember we started with 60 units at a cost of $70 each, value of $4,200. Now, on March 9, 130 units were calculated at a unit cost of $65, total value of $8,450. At this point, we have 190 units, 60 from our beginning inventory, 130 new, and to value them with the weighted average method, we need to determine the average cost. So we're going to come down here and do the first calculation. To determine the weighted average cost, we add together the two costs of $4,200 from our beginning inventory plus the new purchase of $8,450, and we will divide that by the total units, and we had 60 to start. We're adding 130. So we are dividing by $12,650 and 190 units. That will give us a average cost of $65.5789474. Now we use dollars and cents, so we will round this to $66.58. So at the end of March 9th, we now have 190 units at a unit cost of $66.58, total value $12,650.20. On the 18th of March, we sell 70. We'll sell them at the unit cost of $66.58, or a sale value of $4,660.60. What's left in inventory? Well, we had 190, we sold 70, so there are 120 left. Our unit cost is $66.58. Continuing on the 24th of March, we purchased 40 units at $80. Total value of $3,200. So we need to recalculate the average cost again. So we will take down below, this is our cost calculation number 2. The costs we have are the $7,989.60 from March 18th, plus the cost for the purchase we just made of $3,200. Gonna get that on my screen here. Units, we had 120, we bought 40, so we now have 160. And our costs, so when I divide that out, I get $69.93.5. Interesting. So I will round that up. So after the purchase, we now have 160 units at a unit cost of $69.94 for a total of $11,190.40. Finally, on the 29th of March, we sell 100 units. These will be sold at the average cost of $69.94 or $6,994, leaving us with 60 units at $69.94 per unit, or $4,196.40. Now, moving down to our self-check, we had ending inventory 60 units. If we subtract our ending inventory dollars, $4,196.40 from our goods available, we come up with cost of goods sold of $11,653.60. Okay, again, these are the things that change depending on the inventory valuation. Our self-check will go up and add together our sales amounts, and we're $1 different. And this can be off due to rounding. Because remember here, we took a ½ cent off. We rounded from 93.5 cents up to 69.94. So our cost of goods sold using this method is going to be a little bit different than our cost of goods sold down below. With weighted average method, we do get variances because we're rounding to 2 decimals instead of carrying the decimals out, but that is considered acceptable. It should be a pretty small difference. This is actually a pretty large difference to have a whole dollar, but we have somewhat large quantities here. In summary, the ending inventory value and cost of goods sold differ depending on the method of inventory valuation that a company chooses. Once a company chooses a method, they do need to stay with that method. Otherwise, the financial statements could be changed each period to fit kind of management's desire. Please take a look at page 282, which discusses the effect of different valuation methods on financial statements.